More than $6 trillion vanished in about an hour. If you were buying the top because it can only go higher, I'm not going to roast you. But I will say this. The market just gave you a lesson you'll never forget. Silver went from around 121 to 108. Gold went from roughly 5,600 to about 5,100. And the worst part isn't the red candles. The worst part is that millions of people are going to be told this was just volatility, and they'll believe it, and they'll do the exact same thing again next time. Somewhere right now, someone is staring at their screen, watching their portfolio bleed, watching positions shrink like air leaking from a tire, and they keep hoping the next refresh will fix it. It won't, because what happened wasn't random. It was mechanical. It was predictable. And if you don't understand the mechanism, you don't just lose money, you become the money. In the last 60 minutes, the market didn't dip. It snapped. It didn't correct. It flushed. Stop losses didn't protect people. They got swept. Leverage didn't amplify gains. It detonated accounts. Gold fell hundreds of dollars. Silver dropped double digits. And the same people who were celebrating yesterday are panicking today because they were never trading a plan. They were trading a feeling. If you're confused, good. Confusion is the doorway to clarity. Because once you see what actually caused this crash, you'll never watch metals the same way again. And you'll stop letting headlines and hype decide your entries and exits. Now let's get into it. Today is January 29th, 2026, around 10:30 a.m. Eastern Time, gold was trading near 5,600 an ounce. Silver was near 121. 60 minutes later, gold was around 5,100 and silver was around 108. And that's roughly 500 off gold and about 13 off silver in an hour. People hear those numbers and shrug until you translate it into real damage. A 100,000 position in silver at the top becomes about 89,000 in the time it takes to watch part of an episode of something you don't even remember tomorrow. Add leverage and that same move can turn into a full account wipe. And if you were holding options expiring this week, the time value doesn't politely wait for you to recover. It evaporates while you argue with reality. Here's the uncomfortable truth about fast crashes. They aren't just selling, they're forced selling. When price drops quickly, leveraged traders don't get to calmly decide what to do. They get margin called. Their broker demands more collateral. If they can't add it immediately, the position is reduced or closed automatically. That selling pushes price lower, which triggers more margin calls, which creates more forced selling. The market becomes a domino line. One liquidation tips into another, and then suddenly you're not looking at a normal move anymore. You're watching a feedback loop. This is why moves like today feel like an ambush. By the time you notice the red candle, the feedback loop has already started. Liquidity thins, spreads widen. Stops fill worse than expected. In a calm market, you can pretend you're in control. In a fast market, the market reminds you who is actually in control. Liquidity. When buyers step away for even a few minutes, price can gap through levels that should have held. The market doesn't care what should happen. It cares about what orders are actually there. And yes, when the drop accelerates, it often feels like stops are being hunted. Sometimes that's just the math of the order book. Stops cluster around obvious levels because humans think alike. If everyone sees the same support line, everyone puts their stop under it. When price breaks, it triggers a wave of stop sells that act like gasoline on a fire. The result can look intentional, even when it's simply crowded positioning, meeting thin liquidity. Either way, the outcome is identical. Weak hands get forced out at the worst moment, and strong hands get opportunity. Now, here's a statement that makes people uncomfortable, but it's honest. Crashes like this rarely come from nowhere. There are usually warning signs. There are always macro triggers brewing, and professional desks often see pressure building earlier than retail does, because they track relationships and flows most people never watch. That doesn't mean there's a cartoon villain behind every candle. It means information is uneven, incentives are real, and preparation beats surprise. So what actually triggered today's trapdoor? Gold and silver didn't crash because gold is broken or silver is over. They crashed because a separate lever moved first, a lever most retail traders ignore until it ruins their day. That lever is the DXY, the US dollar index. If you only remember one thing from this entire script, remember this. Metals are not traded in isolation. Gold and silver are priced in dollars, which means the value of the dollar is part of the price. When the dollar strengthens, it often pressures metals lower. When the dollar weakens, it often supports metals higher. It's not a perfect lockstep relationship every minute of every day, but it's one of the most important intermarket links in the entire space. Ignore it, and you'll keep getting blindsided. DXY measures the dollar against a basket of major currencies, primarily the euro, but also the yen, the pound, the Canadian dollar, the Swedish krona, and the Swiss franc. When DXY rises, the dollar is strengthening versus that basket. When DXY falls, the dollar is weakening. You can think of it like a scoreboard for the dollar's relative power. Here's the simple seesaw. Dollar up, metals down. Dollar down, metals up. Why? Because if the dollar is stronger, it takes fewer dollars to buy the same ounce of gold. So the dollar-denominated price tends to fall. If the dollar is weaker, it takes more dollars to buy that ounce, so the price tends to rise. Professionals don't only watch the gold chart or the silver chart, they watch the dollar because the dollar often moves first. The dollar is the tide, metals are the boats. If you refuse to look at the tide, you'll keep acting shocked when the boats move. Today, the tide surged, DXY pumped, and the boats got slammed. Now, before someone jumps in with, but gold and the dollar can go up together, yes, sometimes they can, especially in certain crisis regimes when everything is about safety and real yields and liquidity. Correlations can bend, but most of the time, especially in quick intraday shocks driven by rate expectations and dollar demand, inverse pressure shows up fast. What matters is that the dollar is a major input into the metal's price, and ignoring it is like trying to drive while pretending the road doesn't exist. So the next question is the real one. Why did DXY surge today? Because the why helps you anticipate whether this was a 1-hour spike or the start of a sustained regime shift. There were three big forces stacking at the same time, and together they created the pressure cooker. First, the Federal Reserve. The Fed has been leaning hawkish. Hawkish means the Fed is signaling tighter conditions, keeping rates higher, staying vigilant on inflation, not rushing into cuts. Dovish would mean the opposite, cutting rates, loosening financial conditions, making dollars cheaper. When U.S. rates are high relative to other countries, global capital tends to seek that yield. If you're a foreign investor and you can earn more holding U.S. treasuries or dollar-denominated assets, you convert into dollars to access that return. More demand for dollars means a stronger dollar. Stronger dollar means pressure on metals. Think of rates like rent on money. If the rent is higher in one place, money moves there. That flow doesn't need to be mysterious. It's incentives. And when the market reprices the future path of rates, when traders suddenly believe the Fed will cut less or later, or maybe not at all, the dollar can jump quickly. DXY is essentially a live display of those expectations and relative comparisons. Many people expected faster, larger rate cuts this year. The market loves to front-run the fantasy of easy money. But the message has been higher for longer. Whether you like it or not, markets respond to rate differentials. Even the suggestion of fewer cuts can support the dollar. And if the dollar gets a sudden bid, metals can get hit quickly, especially when positioning is crowded and leverage is high. Second, China, and this matters more for silver than most people admit. Silver is not only a precious metal, it's also an industrial metal. A large chunk of demand is tied to manufacturing and technology, solar panels, electronics, EV components, semiconductors, and the infrastructure behind data and automation. When China's manufacturing activity slows, or when data hints at contraction, traders fear weaker industrial demand. That fear gets priced into silver fast. Silver is more volatile than gold and more sensitive to those shifts in real economy expectations. If you've ever wondered why silver feels like it has mood swings, this is part of it. Gold is mostly about monetary confidence, real rates, and safety. Silver has to carry that story plus the industrial story. When the economy looks strong, silver can outperform because it gets both tailwinds. When the economy looks shaky, silver can underperform because the industrial tailwind flips into a headwind. Third, political uncertainty in the United States, specifically the government shutdown deadline on January 31st. Markets dislike uncertainty because uncertainty widens the range of outcomes. Traders don't need to know the final outcome to react. They just need a reason to reduce risk. Shutdown talk creates headlines. Headlines create positioning adjustments. And after a massive monthly rally, there was plenty of profit sitting in metals. A lot of traders were looking for an excuse to take some off the table, lock gains, and reduce exposure before uncertainty hits. So you had Fed hawkishness supporting the dollar, China concerns weighing on industrial demand expectations, and a political deadline injecting uncertainty. One of these alone might have caused a dip. All three stacking at once can create a trapdoor. Then leverage does what leverage always does. It accelerates the fall. And there's one more quiet ingredient that makes drops like this feel sudden: positioning. When a market has been ripping higher on a popular narrative, positions get crowded. People pile in. They add leverage. They stop respecting risk because the market has rewarded them for not respecting it. That's when the system becomes fragile. In a fragile market, it doesn't take much to cause a sharp move. It just takes the right nudge at the right time. Now let's talk about the gold-silver relationship, because people consistently misunderstand it. Gold and silver often move in the same direction, but not with the same intensity. Silver is an amplifier. When gold moves, silver tends to exaggerate it. When gold rises 5%, silver might rise 10% or more. When gold falls 5%, silver might fall 10% or more. That's why silver can make you feel like a genius on the way up and a fool on the way down. It's not that silver is crazy. It's that silver is thinner, more volatile, and more emotionally traded. Today's numbers show it. Gold dropped around 9% from 5,600 to 5,100. Silver dropped around 11% from 121 to 108. And in the moment, it felt even worse because speed is what breaks people. A slow decline is stressful. A fast decline is terrifying. Speed turns rational traders into emotional traders, and emotional traders do exactly what the market wants them to do: make decisions at the worst possible time. There's another nuance too. Not every silver crash is the same type of crash. Sometimes silver dumps while gold holds up, which can signal a silver-specific driver, industrial fears, a shift in demand expectations, or technical positioning concentrated in silver. Other times, both gold and silver dump together, which often signals a macro driver: the dollar, rates, liquidity, global risk. Today, both move down hard together, which is why the DXY explanation matters. When you see both metals fall in sync, zoom out and check the macro levers first. Now here's the part that makes people sit up straight. This pattern isn't ancient history, it just happened. Late December 2025, the last 2 days of the year, we saw a sharp flush. Same panic, same doom, same it's over posts, same feeling that the rally was dead. Then January arrived and ripped higher with one of the biggest monthly moves in decades. Gold surged roughly 30%, silver surged roughly 65%. People who panic sold in December didn't just lose money, they lost position, and they watched the rebound without them. That's why these shakeouts matter. The market doesn't just take money, it takes confidence. It takes your ability to hold. It makes you question your thesis at the worst possible moment. It makes you feel like you're the only person who doesn't know what's happening. Then it turns around and runs the other way, leaving you with regret. So when we get another violent flush near month end, right when emotions are stretched and positioning is crowded, it's worth asking, is this the end, or is it the reset before another leg up? Let's be honest, nobody can guarantee the next move, but you can map scenarios and track the levers, and that alone puts you ahead of most people. Scenario 1, the broader bull trend remains intact, and today was a shakeout. The flush clears leverage, resets sentiment, shakes out weak hands, and then buyers step in. February begins with strength, and metals start rebuilding toward new highs. This is the pain now, gain later path. The market punishes late buyers and rewards patient buyers. If the dollar spike fades and DXY rolls over, the bounce can be aggressive because the same momentum that fueled the fall can fuel the rise once the pressure releases. Scenario 2, more pain first. The Fed stays hawkish or turns even more hawkish, the dollar continues to rise, China data worsens, and metals get another leg down. In this scenario, gold could test lower levels, and silver could revisit deeper supports. It's not impossible. If the dollar enters a sustained uptrend and global liquidity tightens, metals can struggle. Anyone telling you it can't go lower is selling you comfort, not truth. Markets can always go lower than you think, especially in the short run. Scenario 3, chop. Sideways, ugly whipsaw action that drains everyone's energy. No clean rally, no clean crash, just a grinding range that makes people bored and frustrated. Then, when the maximum number of people give up, the real move happens. This is the scenario that quietly destroys more traders than a crash, because it bleeds you through overtrading and mental exhaustion. Now, here's the on-the-record call that people either love or hate. Silver back above 120 by February 15th. Not by summer, not by eventually. By February 15th. That doesn't mean a straight lineup. It doesn't mean there won't be more volatility. It's a time frame call, based on the idea that violent flushes inside a broader uptrend often snap back once forced selling is done and once fear events get digested. If the shutdown drama resolves or fades, if the dollar spike cools, silver can rebound fast because silver doesn't do gentle recoveries. It whips. But even if you don't like that call, the bigger point is more important than the prediction. You need a framework. You need to know what to watch, and you need to know what you're actually trading. So what do you do with this information? It depends on what you're holding and why. If you hold physical gold and silver, your job is to think long term. Physical metal is not a day trade. It's not a slot machine. It's not something you dump because the chart scared you for an hour. Physical is a long-term store of value, a form of insurance, a hedge against currency risk, a hedge against financial stress. If you own ounces, you still own ounces. Your stack didn't shrink because the screen price moved. The screen price is a quote, not a thief. The market can change the quote. It can't take your metal. This is where perspective matters. In 2020, gold sold off sharply during the initial shock because liquidity mattered more than narratives in the first wave. People needed cash. They sold what they could. Later, gold recovered and pushed to new highs. In 2008, silver got crushed during the crisis, and people declared it dead. Then, in the years that followed, silver rallied massively. Every bull market contains brutal corrections. Corrections are not proof the thesis is wrong. They're proof that markets are designed to test conviction. If you're trading paper metals, futures, options, leveraged products, then today was a reminder that volatility is not a theory, it's a weapon. Leverage in volatile markets can be a death sentence. People love leverage when it works. They hate it when it does what it's designed to do, magnify outcomes. And the problem is that in fast markets, your stop loss isn't a magic shield. Stops can be skipped, liquidity can vanish, your fill can be far worse than your plan. That's how accounts die, by assuming the market will give you your price when the market is in panic mode. So if you're a trader, here are the questions you should be asking yourself tonight, not tomorrow. What is your maximum acceptable loss on a position? Not a vague number, a hard number. If you can't answer that, you're not trading, you're gambling. What is your position size relative to your total account? If one move can take you out, your size is too big. What is your time horizon? If you're trading short term, accept that you're playing the volatility game in size accordingly. If you're investing long term, stop using tools that can liquidate you in an hour. If you insist on using leverage, use less than you think you can handle. Position size, like the market, is trying to embarrass you. Because it is. Use time, use patience. Don't put yourself in a position where 1 hour can erase your future. The goal isn't to hit a home run. The goal is to stay in the game long enough to let probabilities work. You can't compound if you're constantly resetting to zero. If you're sitting in cash and you've been waiting for a better price, understand this. The best buying moments rarely feel safe. They feel scary. They feel like you might be catching a falling knife. That's why most people don't buy them. They wait for comfort. Comfort arrives after price has already moved higher. Opportunity is uncomfortable by design, but don't confuse buying the dip with going all in. Smart accumulation is layered. It's scaling in. It's leaving room for more downside. It's only using money you can hold through turbulence. If you buy some here and price drops again, you can buy more. That's how you average in without letting one entry decide your entire fate. The best investors don't need to nail the exact bottom. They need to build a position at good prices and survive the process. Now for the people who bought the top and are feeling sick, breathe. You're not alone. Most people learn risk the hard way. The market teaches. It doesn't explain. But you still have choices. Panic selling into a flush makes the loss permanent. Holding without a plan is also dangerous because it turns investing into hope. The move is to step back, zoom out, decide what you actually own, decide why you own it, decide what your time frame is, and decide what you'll do if price goes lower or higher. And here's a truth that can save you. You don't have to act while you're emotional. You're allowed to pause. You're allowed to wait for your nervous system to calm down. The market will still be there in an hour, in a day, in a week. The worst decisions are made in the first wave of fear, when your brain is convinced that the only way to feel better is to hit the sell button. That's not strategy. That's relief seeking. Relief seeking is expensive. Ask yourself this. If metals drop another 10%, do you have a plan? If metals rally 20%, do you have a plan? If metals go sideways for weeks, do you have a plan? The market doesn't care about your emotions. It rewards preparation. It rewards patience. It rewards people who think in probabilities instead of certainties. This is why I keep coming back to the drivers. Because once you understand the drivers, you stop being shocked. You stop interpreting every candle as, the market hates me. You start seeing what's actually happening. When the dollar spikes, you know what that pressure does. When Fed expectations shift, you know what that implies. When China data surprises, you know where silver's vulnerability is. When political uncertainty rises, you know why risk gets reduced. Here's what I'm watching next, and you should too. First, the DXY. If the dollar continues to pump and hold, metals can stay pressured. If the dollar spike fades and DXY rolls over, metals can bounce hard. The dollar is the lever. Second, the days around the shutdown deadline in the first week of February. Markets will show you quickly whether the fear was priced in or whether uncertainty is expanding. Watch how price behaves after the deadline, not just what headlines say. Headlines can mislead. Price often tells the truth. If the market sells the rumor and then stops selling after the event, that's information. If it continues selling even after the event, that's also information. Third, China data and any credible signs of stimulus or stabilization. Silver is sensitive to industrial expectations. A shift in narrative can move silver quickly in both directions. Traders don't need the economy to be perfect. They need the direction of change. If the data stops getting worse or if stimulus becomes more credible, silver can react. Fourth, Fed communication. Every speech, every hint, every recalibration of expectations can move the dollar. And if the dollar moves, metals react. Also, watch one more thing people ignore. Liquidity conditions. When financial conditions tighten, risk assets and speculative positions often get hit. and that can spill into metals, especially in leveraged paper markets. When liquidity improves, the opposite can happen. Money flow matters as much as narrative. Now, let's talk about the story beneath the story, because this is where long-term holders build conviction. A lot of the big picture reasons people are interested in metals don't change because of a 1-hour flush. Structural trends don't reverse in 60 minutes. Long-term buyers don't stop accumulating because an intraday candle looks ugly. Supply realities don't reset because social media is panicking. What corrections do is test you. They ask, did you buy because you understood why you were buying? Or did you buy because you felt FOMO and you wanted to be right? If it was FOMO, the first crash will shake you out. If it was understanding, the crash becomes data, not trauma. Now, let's be honest about why today felt so brutal for so many people. It's not just the percentage drop. It's the timing and the psychology. January had been powerful. It felt like the market was confirming every bullish story at once. That's when people increase risk. They tell themselves, I should have bought more. They add size late. They convince themselves the only risk is missing out. That's exactly when the market loves to punish. Not because the market is evil, but because markets move to frustrate the largest number of participants at the extremes. That's why the end of December flush was so effective. It shook people out right before the strongest move. It created maximum regret. And regret is fuel for the next chase. People who sold the bottom watched January explode, and then they bought late in January because they couldn't stand missing out again. And then, right when they finally re-entered, the market flushed again. That is how the machine works. It squeezes emotions until they produce bad decisions. So what breaks that cycle? A plan, but not a vague plan, a real one. If you are a trader, define your time frame before you enter. Are you trading intraday, swing, or position? If you're intraday, accept that you will be wrong often and focus on risk. If you're swing, accept that volatility will test your stops. If you're position trading, accept that you may need to endure drawdowns without flinching. Then size your position so that your plan is actually executable. A plan that you can't follow under stress is not a plan. It's a fantasy. If you are an investor, define why you own metals. Is it inflation hedge, currency hedge, crisis hedge, diversification, long-term store of value? Then define your accumulation strategy. Are you buying monthly regardless of price? Are you buying heavier on dips? Are you holding a base position and trading a smaller portion? The point is to decide before the crash, not during it. And if you're somewhere in between, holding some physical and trading some paper, separate those buckets in your mind. Don't let a trade loss make you doubt your long-term holdings. Don't let a long-term thesis convince you to ignore risk on a leveraged trade. Different tools, different rules. Now let's talk about what most people will miss, even after hearing all this. The cause of the crash isn't one headline, it's a chain. The dollar moves, metals respond, leverage amplifies, stops cascade, sentiment flips, and the narratives get written after the fact. Most people live in the narrative. Professionals live in the chain. If you learn to see the chain, you become harder to shake out. One last thing, and it's the part nobody wants to hear when they're hurting. Your biggest enemy in a crash is not the candle, it's your reaction to it. If you want a simple routine that saves people in moments like this, do this. Step away from the chart for 10 minutes. Breathe until your heart rate slows. Then come back and answer 3 questions on paper, not in your head. What am I holding? Why am I holding it? What is my next action if price goes lower? And what is my next action if price goes higher? If you can't answer, you don't have a strategy yet. You have exposure. Also, stop trying to win back losses with revenge trades. That urges the market's trap. It turns one bad entry into 5. If you missed the top, if you got caught, accept the lesson and protect your account. Set alerts instead of staring at every tick. Track the DXY the same way you track the metal price. If you can, overlay DXY and metals on your charts so you see the relationship with your own eyes. Watch how metals react when DXY spikes and when it fades. After a few weeks, you'll stop treating metals like random chaos and start seeing the rhythm. And if you're new and you feel embarrassed, don't. Every skilled trader has a scar from a day like today. The difference is that the skilled trader didn't quit. They adapted. They reduced leverage, tightened process, and built rules that keep them alive. The market doesn't require perfection. It requires survival. Survive first. Optimize later. That's how you end up on the right side of the next wealth transfer. Right now, trillions didn't just disappear. They changed hands. Someone sold in panic. Someone bought with patience. Someone got liquidated. Someone got filled at a discount. The market is a machine that transfers wealth from the impatient to the prepared. That's not a quote for a poster. It's observable behavior in every major flush. So decide which side you want to be on next time, because there will be a next time. The market will do this again, maybe not tomorrow, but again. Volatility isn't an accident. It's part of the design. It shakes out weak positioning. It punishes arrogance. It rewards discipline. If you want to survive and win in metals, stop watching only the metal. Watch the drivers, watch the dollar, watch the rate expectations, watch the macro conditions, watch liquidity. When you do, crashes stop feeling like random lightning bolts and start feeling like storms you can see forming on the horizon. And remember the promise I made earlier, silver above 120 by February 15th. Screenshot it, save it, hold it accountable. If it happens, it won't be magic. It will be the mechanics unwinding in the other direction. Forced selling ending, fear fading, dollars cooling, buyers stepping back in. If it doesn't happen, the framework still wins, because you'll understand why price failed and what changed. Either way, the goal is the same. Stop being surprised, stop being exit liquidity, and start trading or holding with a real plan instead of a viral narrative. Stay calm, stay prepared, and whatever you do, don't let 1 hour of chaos decide your entire financial future.